Okay, we're going to talk about the first of those terms that we mentioned in the last video. The first one we're going to mention or bring up is deferred expenses, right? Words very, very specific. Deferred means to postpone, and we know what an expense is, right? So we're postponing the recognition of an expense. That's what happens in this kind of an adjusting entry, right? We're doing adjusting journal entries. So the foundation of this is that we have an asset, right? We buy something, and then some event happens, right? Some event or something happens, and that asset turns into an expense, right? So we buy an asset, something happens, it's going to be an expense. So when I buy that asset, what am I doing? I am deferring the recognition of the expense until I use that thing up, right? So, for instance, when we buy supplies, what are those supplies to us? We treat supplies as an asset, right? So we know that supplies, I buy them, they're an asset. So I go to the store and I buy a bunch of Post-it notes, right? And I put those things in my closet, and I own those Post-it notes. They're an asset to me. But what happens during the accounting period? Somebody comes along and uses up my supplies, right? They take supplies out of my closet. So the event that happens, right, is what? They get used up, right? They get used up, and they turn into supplies expense, right? Another example we might look at is insurance. When I buy insurance, I buy a policy that's probably a year long, right? So I buy insurance. If I cancel it tomorrow, I would get all of my money back, right? So we know prepaid insurance is what? An asset, right? When I buy it, we record it as an asset. Time passes, right? Time passes, and eventually we use that up and it becomes insurance expense. So again, we're doing what? We are deferring the recognition of an expense, right? Now we're going to go through a couple of examples of these so you can see kind of how it works. We're going to use T accounts to look at it in journal entries, so that's going to be our frame of reference, right? So if I have a company that buys a 12-month insurance policy on December 1st for $600, right? To December 1st, 2016. So if you think about it, right, we can take this time period and we can divide it into what? 2016 and 2017, right? So I know that I buy this insurance policy when? Well, if this would be what, December 31st, right? So around here I buy this insurance policy, and this insurance policy lasts me a whole year. It lasts me till next year in December, right? So that insurance provides me benefit over all of these periods, right? Let's do the journal entries. Let's buy this thing. I'm going to slide this up a bit. So when I buy this on December 1st, right, 12/1, I do what? I'm going to write this kind of small because I don't want to run out of room. I book it as an asset, right? Prepaid insurance and cash, right? $600, right? That's what I do on the 1st of December. And I have this account, prepaid insurance, right? Now I gotta go up just a little bit more. That's all there is. And we also have insurance expense, right? Because that's just how it is. So when I buy this, I have prepaid insurance, and if I post this to my T account, I know that I have a balance here of what, $600, right? In my prepaid insurance account, and that is as of the 1st of December, right? Well, now what happens on December 31st? It's the end of my accounting period, right? And I've had this insurance for a month, right? So that means I've used up some of it, but I have some of it to carry forward into the next accounting period, right? So on 12/31, I have to do an adjusting journal entry, right? I'm going to do an adjusting journal entry, and I'm going to bring these accounts up to date. I'm going to show that we've used up 1 month worth of insurance, right? And that it's gone, right? So I'm going to do an adjusting journal entry that says what? Insurance, expense, and prepaid insurance, right? For how much? Well, this is a 12-month policy, right? So every month I divide 12 into 600. Every month we use up how much? $50 worth of that insurance, right? $50 worth of that insurance. So I do this adjusting journal entry, right? Now, I post it, so insurance expense has a balance of $50, right? Prepaid insurance gets a credit of $50. So that means what? We are carrying forward $550 of insurance into 2017, right? And my December 31st, 2016 income statement's going to show expense of $50, right? So when we talk about adjusting journal entries for the deferred expense, this is one example of them, right? This was an asset, and this asset turned into an expense, right? Couple of key things. Cash will never be a part of an adjusting entry, right? This adjusting journal entry, cash will never be a part of it, okay? Because cash is always kept up to date. The other thing is that every adjusting entry affects at least one income statement account and one balance sheet account. We know interest or insurance expense belongs where? That goes on my income statement, right? Because it's an expense account. Prepaid insurance is an asset that goes on my balance sheet, right? That goes on the balance sheet. So that's one example of a deferred expense, right? We'll do another one real quick. The other one that we have is supplies, right? Now, this one, end of December, a company's general ledger for supplies shows a balance of $1,200. A physical account shows supplies on hand of $300, right? So, we're going to draw our T account, right? We know that we have supplies, and it says what? Our general ledger shows that we have $1,200 of supplies. That's before adjustment, right? So we bought $1,200 worth of supplies. A physical account shows that at the end of the period, we have what? $300 left, right? So that means I have $300 left in my closet. So my ending balance is $300. We know on the trial balance it's showing $1,200, right? So what does that mean? We've used up some of our supplies, right? 1,200 minus 300 means what? That we've used up $900 worth of supplies. Well, that's our adjusting journal entry, right? So I know my adjusting journal entry is going to do what? Reduce supplies by 900, so we'll just do that, right? Reduce supplies by 900 with a credit to that asset, and I'm going to debit an account called supplies expense, right? That's my adjusting journal entry. Look at what happens. I've turned this asset into an expense, right? I'm running out of room, but let's say this is what? Supplies expense. We know that what? $900 here, $900 there is our debit and credit in the T accounts, right? And that is the adjusting journal entry. Remember? Income statement account, balance sheet account. So, those are some examples of deferred expenses.